Featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Welcome to Your Money, Your Call, Bonds versus Equities. I'm Todd from FIIG Securities, and if you have any questions whatsoever about the share or bond market, please pick up the phone, call us 1300 30 34 35 and the email yourmoney@skynews.com.au. Joining me on the panel tonight is Roger Montgomery from the Montgomery Fund and Adam Goldstein. Adam is the chair of the New South Wales chapter of SPA and he is a principal with Skeggs Goldstein. Welcome, gentlemen. How are you?
I'm good. Glad to be here.
Volatile week,
Sure.
Market's up. Today it finishes up. I think NAB was up 3-something%. I was looking at some of the reports and everything's rallying, it's all over. It's good.
For today.
For
Well, it's because we're just coming up to June 30, and everything gets dressed up nicely for June 30 and then it all gets dumped in a heap on July 1.
Let's go again in July. Market volatility is a theme. I mean, how are you finding it with your customers? I mean, what's the reaction to your clients about all the volatility in the market that's come about since Bernanke sneezed?
Extremely concerning, obviously, but it hasn't been any different for the last 5 years, I must admit. So some of our clients are taking it in their stride, to be honest, but they see opportunities as well as a lot of risk and concern. My job is to help them set some expectations and put some clarity around this for them. I'm finding, though, that most of our clients find it difficult to separate what's happening in economies as opposed to what's happening in markets.
Yep.
The two don't always correlate.
They never do.
They never do.
So markets are supposed to be forward indicators, which I think is absolutely rubbish. I mean,
don't invest on the basis of what the economy is doing, unless of course you can see that the changes in the economy are going to have an impact on, in my case, the businesses that we buy for
Sure,
our
absolutely. The technology has that moat around the protection. New products come in. What about you for volatility? Is it a good thing?
It's an opportunity for us. About 4 weeks ago. 4 weeks ago, we went to about 44% cash. Actually, it was about five weeks ago, and we're now 55% cash. So this sell-off in the equity market that we've experienced is actually, we see it as an opportunity. Yeah. We just had our investment committee meeting yesterday, on Thursday, and what we did discover though is the sort of companies that we want to buy aren't cheap enough yet.
Right.
And we're fortunate that in the Montgomery Private Fund, we have a lot of some very high-profile business people and leaders in industry and entrepreneurs, and we have a lot of dialogue with them about what's going on in their particular sector of the economy, and the picture isn't encouraging.
Yep.
And so for us, we're delighted to have that much cash, and we see lower prices inevitably. And that means we'll be able to pick them up cheaply.
I'm going to ask you a question without notice. Newcrest.
Yeah.
I'm not an equity guy, but Newcrest came out with a profit downgrade. The prices get belted. All the analysts came out with some commentary. A lot of people came out early and said we think there'll be a profit downgrade, and then there's been some analysis around. Hang on, did they do this properly? What's your interpretation of how that all played out in the press? Is that something that's of some concern, or did they just do what they're supposed to be doing?
No, in fact, I remember being on this very program, not with you, Mark, but with Chris Kimber and Ben Clark.
Yep.
And we went around the table asking what our valuations were for Newcrest the middle of last year, or actually earlier, maybe a bit earlier than that. And it was trading, I think, around the $30 mark or $35. And our valuation was about 15.
Yeah.
And we were laughed at, as you can imagine. Clearly something's wrong with us, and here we are.
At 15.
So we think Newcrest is singularly the most expensive, or it was the most expensive gold producer in the world that was listed, and our valuation was significantly low. We couldn't justify it.
Yep. So how do you find it when your customers who might have had Newcrest,
We do have Newcrest.
is that a tough phone call to take? I mean, how does that play out in respect of, hang on, we should be better informed, we feel we're uninformed? I mean, what's the interpretation from your customers?
Frustration, without a doubt. Frustration for me as well.
Yeah.
The news filters down, and we filter that news onto our clients. By the time that happens, generally it's too late.
It's down to $15 from $20 or whatever it might be.
And we're in a situation now, what do we do?
What about Cochlear?
Yeah.
Now, you and I spoke about Cochlear. We were thinking that was a good, buy opportunity.
So we've owned it a couple of times. Yeah, we've owned it a couple of times, and we still had a little bit of stock left when the announcement came out, the latest downgrade. We didn't have a lot; it wasn't a huge part of our portfolio. But having said that, the stock has since bounced off its lows, and we think there's value at lower prices. However, we're a little bit curious as to the fact that there's been very little growth in profits since 2009. So we think that there's something more to it than just this latest situation where there's been a supposed holding off of purchasing of cochlear implants ahead of the release of the new product. We think there might be more to it than that, but we're just going to wait until the full year results come out and have another look at it then.
Are they being caught up in, and in Cochlear it might be different because they're talking about the competition and affecting their profitability and their moat and all that sort of stuff. I understand all that.
I think it's overstated.
I find that very hard to understand. I read the report, and this is what we say about people in fixed income. We look at the report. We're often talking about Sydney airports. We're often talking about these organisations. They have very substantial moats that if they were easy to break into, they would have done it on Monday. They would have broken in on a Tuesday. They would have done it earlier.
The stock market
is illogical.
That's what's so great about the stock market.
Or so terrible if you're holding Newcrest.
Yeah, well, the key is obviously to make sure that you're in the best quality businesses and you've bought them at below their valuations.
You tend to find that out after it's gone up and you become the flotsam and jetsam as you're trying to say, how do I get a performance? And CBA's at 73 down to 65 or whatever it would have gone to.
Yeah, look, I think too many people focus on prices and they don't focus on valuations. And the key is very much to focus on intrinsic values, which change much more slowly than the price.
Yep.
And if you anchor yourself on valuations, then you see the price for what it is.
So you're not as concerned about the volatility?
Not at all, it's an opportunity.
Volatility was driven by Bernanke blinking. He was in an unpleasant environment. He was talking to a Republican. The Republican said, "Will you consider unwinding?" Subject to the data being good, we'll look to taper. Yeah, we'll look to taper. The market sneezed. The market said that's terrible. We've got this heightened volatility over a couple of weeks. What do you make of it? What do you make of the idea that he hasn't actually looked to taper? He's just said consider it. Do you think that the equity market had lost oxygen at those levels already?
No, I think the bigger issue is that quantitative easing isn't working. Since it started in September 2011, the Federal Reserve has expanded its balance sheet by 18%. Right, and they're now buying $85 billion worth of bonds every month.
Yeah.
And yet inflation back in September 2011 was 3.9%. It's now 1.1%. So the statement was, and I think it was the St. Louis Fed president that came out and said, we will continue quantitative easing until we see a recovery in employment.
In the job market, yeah.
In the job market. So we're seeing that. But we should have seen prices stabilise at least, and we're not. Prices are declining. That shouldn't be happening. And I think the deflation concern is starting to mount. And if you combine the deflation issue, and Japan is now winning the currency war,
yeah, absolutely.
And they're exporting deflation and everyone's cutting prices to compete. If you consider those two things, along with the fact that the World Bank has come out and cut world growth,
yeah.
Emerging market growth is slowing, that's bad for commodity prices. Those three things together, well, there's a possibility for an emerging market debt crisis again. And so the safest place to be is in cash. Now, that's not the reason we're in cash. We're in cash because things got expensive up at the highs a few weeks ago, and so we decided to take profit. But it makes sense to have cash in this environment.
I hear what you're saying. What do you think about the US markets? I mean, in terms of that Bernanke movement, was that something that you look back and said, I wouldn't have expected the amount of volatility to come from just an innocuous response? Well, of course they should consider it. That's their job. They consider tapering.
I think the market's looking for an answer of a date, and I doubt that Bernanke's going to be able to do that. I think that might muddle and confuse and keep us guessing for a little bit longer and do it over a gradual period of time.
It's your classic response to the sugar hit. Once you lose it, you react badly.
But
once the fear of losing it, we'll talk about that.
But inflation's declining.
Well, we'll talk about that inflation because I've got some themes on that inflation, but we must go to a break.
QE won't taper for a while.
We've got to pay for the show.
Okay.
We'll be off to a break. We'll be right back. Welcome back to the Bond edition of Your Money, Your Call. I'm Mark Todd, and tonight on the panel we have Roger Montgomery from the Montgomery Fund and we have Adam Goldstein. Adam is the chair of the New South Wales chapter of SPA, and he's the principal of FIIG Goldstein. They're here to answer any of your questions tonight. So pick up the phone and give us a call on 1300 30 34 35 with the email yourmoney@skynews.com.au. And we'll go to our first email of the night, and the email is from Matt, and Matt writes, I am very interested in buying bonds, but I need to understand some of the terms. What is accrued interest and what is the dirty price and the clean price? Sounds quite rude, doesn't it?
Well, it sounds illegal.
It's dirty. The accrued interest is in the same way the equity market works around the dividends. The dividends, once you pay the dividend, it drops. The accrued is the component that's owed. So when you sell a bond, you get that interest. And that leads me to the dirty and clean. The clean price is the price you buy the bond. The dirty price is when you add the interest back on top. So if it's worth $1, you know, and it's $1 on top of whatever the price you're paying. So hopefully that answers your question, Matt, who's from Sydney. Can we just shift gears just a little bit, because we do need to come back and talk about the impact on the inflation in the United States and the rest of us. But tell me a little bit about SPA, because I just want the viewers to know the role that you play. FIIG Goldstein has two different businesses, as I understand it. But what about the SPA role? Because that keeps you very busy, doesn't it?
So FIIG Goldstein first, we're a wealth and accounting practice located here in Sydney. My involvement with SPA started in 2003. So SPA is essentially an association that was established by a group of advisors, accountants, financial planners and lawyers with the sole purpose of increasing professionalism and knowledge in the SMSF advice space. That was 10 years ago, and 10 years down the track we're up to about nearly 3,000 members. Of those 3,000 members, they account for probably 80% of the SMSFs that are in the marketplace today.
Right.
So very impacting.
And a massively growing business, the SMSF.
Oh, without a doubt.
Yeah.
Our two key focuses in SPA are our two specialist advisor designations, which is an SSA specialist advisor and SSAUD, which is a specialist SMSF auditor.
Right.
So,
I mean, that must be a target growth for somebody in your line of work in terms of that self-managed super fund. The driver of that is wanting more information, control, ownership, the idea that they could come to you and say, look, I'm much more engaged in terms of how you go about talking about equities.
Well, nobody's going to look after your money better than you.
Correct.
Or no one's going to care about it more than you.
Or lose sleep like you do.
So, yeah, but you know, so to be able to make the decisions yourself about where you invest those funds, and there's plenty of flexibility about where you can invest that money.
Yeah.
You know, no wonder it's popular.
It is. It's absolutely incredibly popular.
Bunnings is popular because Australia is a DIY country. People like to do it themselves.
It's in our DNA.
But we know that's true only since 2008. That's where it is, where we lost the trust of the people that were supposed to be the experts in our advice. And you know, this chap Michael Lewis in the paper today was talking about he was given a broker from Merrill's from an existing relationship, and he just didn't feel like he should tell the guy, you know, I just don't want you as my broker, and he felt there was family connections.
Yes.
And they put him into Lehman's. And all of a sudden he went, oops, you know,
Yes.
and I'm sure he meant well when he put him into Lehman's, but, you know, people are, you know, not uniquely perfect to make these decisions, so you need to take some ownership yourself.
I think there's a couple of very special skills that you need in order, for example, to pick equities, and it requires you to understand or recognise a good business from a bad business, and then the second skill is to be able to value the business. But notice that I talk about businesses. Many of the professionals in the industry talk about stocks, and what they're looking at buying stocks that go up. To me, that's the same as betting on black or red. You know, you're just betting on up. But that's very different to investing in businesses.
I can't tell you how frustrated I've been over the last month, which was sell the banks, buy BHP. That's the trade. And it might even be right, but it wasn't any logic. It was only in hindsight that it become better because
it's
everyone.
the daily double at Randwick, you know.
That's right. It's because all these foreigners are now selling because the currency and because the RBA moved 25 basis points. That just was more evidence that you need to take more control of, because that was just the herd. Yep. If the herd's selling the Aussie, that's crazy.
A broker sent a report out yesterday saying, firstly, that he was very worried about a massive, massive decline in the United States market overnight, and it bounced, it was up 1.5%, so put that aside.
But he was concerned, he wasn't lying, I'm just concerned, I don't know. that'll happen.
Somebody should learn that, somebody needs to learn that you cannot predict short-term share prices, so don't even bother trying.
Exactly.
But at the same time, this particular broker said that the reason he got his bank call wrong was he underestimated how many foreign trend-following hedge funds.
Yeah. What's that?
I think this stuff's just made up. Really,
It is completely made up.
Because the reason why banks were expensive is because everyone was chasing yield, and the sales agents who were telling investors where to go was proffering the story.
Absolutely,
that you
get
go
into
for
the yield. They're just like a term deposit.
But investing in stocks is all about intrinsic value.
Which brings me to my next question. Equities have been sold off, not today, but clearly they've been sold off. Credit markets, bonds have been sold off. We hear that the
emerging market bonds have had their bubble burst. It's the worst situation since 1994.
Right.
You're not in emerging market
we can
bonds,
argue what that means, because no, I'm not. But you're doing the herd thing. You're following. It's the same thing.
No, I'm just commenting on what's happened.
But I get it. But it's the emerging market bond market is for those blokes who are hedge funds who got caught and they got short and then it's all a disaster. My question is, what's everyone doing with the money? If they're selling the emerging market bonds, if they're selling the equity markets, are they really just going to cash at 2.5%?
Well, do you know what? If you have a choice of earning 2.5% on cash or losing 20%, which one are you going to choose?
No, I'm with you, but
are you seeing cash? So you've got to, from our perspective, and one of the great advantages that we have over other much larger peers is that we can swing to very large amounts of cash in the fund, and we think that investors now need that, particularly as they retire. They need to protect their capital. And so we think, in the absence of a suitably attractive investment, the only place to be is cash. There's no other place that's safer.
Not arguing at all. My question is that what you're seeing? I mean, I understand that your fund is, but in terms of peers, markets, your customers, you seeing everyone just saying, I'm out of everything and I'm just going to go to cash? Is that the trend that you're seeing? Because
no, we don't do the whole out of everything into equity thing. But people are holding cash longer, they're holding their TDs longer. TD rates are still holding up a little bit at the moment.
3.8.
Well, you're still getting 4.05 or 4.3. Or
Suncorp came out last week with 3 months at 4.50.
So you're still getting decent.
ING was at 4.20.
But can you put serious amounts of money into that? Because
I think the problem.
I've got about 100 million I need.
I think that'd make you a rate for sure, because I think the issue is not so much can you put serious money. They're actually dropping it down because they had the benchmarks too high, so they were saying a minimum of $1 million, this sort of thing, because they were looking to aggregate. And then they've decided. ME Bank came out with some great rates and offered them lower.
Often they're online and it's
you can no. Well, listen, Roger, we'll open up an account with FIIG and you can do your term deposits with us, and that'll be fine.
Will you make an investment?
Sonica Singh will talk to you. She's fantastic. Okay, I'll get you some private clients and you can give me some cash.
And we'll do your accounting for you.
Exactly. That's a perfect, unique world we've got going. With that in mind, cash rates, what do you think? Is it, if everyone's moving into cash, do we see cash rates going low?
Do you want to go first?
Yeah, well, the market's saying cash rates are going to be lower. The 3-year bond rate's 256 or something, 259. What's the official rate? 275. The 10-year bonds at 3, so short-term rates are definitely on their way down. That's the market's telling us. So I'd imagine, this is my educated guess, and we're probably looking at a rate reduction in August, maybe not July, or somewhere towards the end of the year. I think that might pull it up though, but that's what the market's telling us right now.
First, many years ago, I did a study. Of Australian short-term interest rates, 11 AM cash rates. Plotted over 10 years the futures yield curve at every date against the cash rate, and what we found was that the market was about 100% wrong when it came to predicting where cash rates were going to go.
Never gets it right.
No, it was about 100% wrong. It never got it right. But having said that, we've got clients that are telling us things are absolutely atrocious in WA. We've seen GDP numbers for WA, they were negative. Northern Territory is negative. We've got a client who's in the coal industry in Queensland. Queensland is now slowing down. People are losing their jobs and fearful of the jobs if they've got one. And so we think that and that was to March, those GDP numbers, we think the next GDP figures will be even weaker. And so there'll be pressure on lower rates.
Obviously lower rates. We are going to go to a break, but before we go to a break, we're going to have Speaker's Corner. And Adam, you're going to be our man for 30 seconds to talk us through your agenda for the day, and your time will start now. and I'll call you in.
My Speaker's Corner today, I'm going to speak about, in the next 16 days, they're going to be changed to the ATO are going to address the penalty regime for SMSF. Up until recently, their only big stick was a 46.5% tax on non-complying funds. From 1 July 2013, that's going to change a little. Their focus is on education, compliance, and a 15-step penalty regime with fines ranging from $860 to $10,200. If you want a fact sheet, please.
Welcome back to the show. If you have a question about bonds or equities, our phone number is 1300 30 34 35 and the email yourmoney@skynews.com.au. Let's start with the question that I wanted to go and say, in terms of the performance, what are your investors expecting? What's the themes there? What is an acceptable number? So if cash rates go lower, we expect cash rates to go to 2.5 or 2. What do you think investors should expect to get?
Yeah, I'm going to preface this again by saying I think that entirely depends on what their strategy is.
Yep.
I've got a bit of an issue with this number of performance which is bandied about, and I think it's largely due to comparative purposes for fund managers and the like.
That's Roger, he's on your left. Compare his numbers, which is pretty good.
We've lost the concept of matching assets to liabilities. So, for example, a client doesn't just come to you and say, I need a rate of return for the rest of my life. They come to you with a whole range of objectives and strategies. Now, my role as a financial advisor and planner is to match suitable assets to those liabilities. Now, for example, short-term liabilities could be the maintaining of a cash bucket, if you like, so that they can draw down an income stream for the next 12 months. Now, obviously, a cash or a TD is appropriate investment for that type of scenario.
Yep.
And on the long term, the long-term liability is the ability to meet their longevity risk. Now, obviously, we're looking at growth assets there, which is going to be their shares in the property, and their short-term, medium-term objectives are going to be the requirement for income. So we're looking at obviously dividend and interest from fixed income. So if you homogenise all those assets together and to give you one number, when markets are going well in growth assets, you're going to underperform because you have the short-term and medium-term liabilities that you need to match with appropriate assets. So I like to break them down into those particular components.
I'm going to go to an email because the timing on that comment is absolutely fantastic. And this email is from Brian. And Brian is referring to a caller that we had last week, and it was on foreign currency bonds. He would wish some guidance on this issue. He has a US dollar. I have US dollars in Australia, and he's looking at Westpac US dollar bond offerings for capital growth, some FX upside, and is it better leaving this in a US dollar than an Australian multi-currency account? What do you think about buying some Westpac bonds in US dollars? And that was the email that Brian had brought through. And we answered it. Chris Joy was here last week, and we answered it, but we weren't granular enough in what we were trying to explain. And the reality is, Brian, that when you're looking to hedge up your FX risk, you have to define if you've got an FX risk. So trading, punting FX is not necessarily the same as investing. And so the idea that you would look to go to an FX account to try and trade it, I would ask that first you look at what your liabilities are. And if your liabilities are things like education, whether it be for your grandchildren, trying to help out on some of those fees that I know a lot of grandparents do, whether it be golf fees, whether it be health costs, whether it be, if that's where all your liabilities are, you should try and sync up your assets to match up with that. But if in the event you have children overseas in the United States, or you have a desire to always holiday in the United States, then to buy one of the four majors in US dollars is a pretty cheap alternative. That's a pretty good idea when the currency is high. When the currency is getting lower, well then maybe not so good. But when it's at 103, 104 and you're always going to have a liability in the United States, absolutely. But if your salesperson comes to sell you an AXA bond in euro, at 3 o'clock in the afternoon, run a mile.
Yeah. Why?
He's the wrong guy.
I was having a chat with someone we'd all know, a friend of mine, a guy named Ross Greenwood, and he after the show he likes to give me a lift over the bridge, and we were chatting about the possibility or the interest in buying a property in France.
Yep.
Why? Because very rarely in your lifetime do you get all your ducks lining up where you've got a really strong currency, a recession in France, weak property prices over there, a weak euro, and you never get that lined up. So on the off chance that that might happen one day in my life, I moved a lot of our currency, well, all of our term deposits out of Australian dollars and into Singapore dollars, British pounds and US dollars.
Yep.
Now the timing was, fluky in the sense that I did it at 101, 102, and it's now where it is. But it's an investment. It's not a trade.
That's right. You can
you're doing
utilise
it because you're thinking you're going to protect your. You're doing it deliberately to protect your foreign purchasing power.
Yeah,
for a purpose.
And it's not really a profit. I don't even see it as a profit. We've made substantial gains out of it, but all it's done is it's just insured me. And it's put me back to where I would have been had the currency been still at $1, $1, $2.
Absolutely. And the other thing is that you utilise, if you're going to the south of France and you have an idea that you and your wife would like to be able to go on holiday there and you can do all that sort of thing.
Ideal.
It makes a lot of sense. But in terms of taking that phone call and punting euro,
it's very different.
That's an entirely different problem, and you don't need to be doing that.
And you need deep pockets if you're going to do it. You need to do it over a longer period of time because the short term's impossible to predict.
Yeah.
But you need to do it over a longer period of time. And I have a firm view that the Aussie dollar doesn't deserve to be at parity. It needs to be lower. Why? Because our economy requires it, because we're so uncompetitive.
Our RBA will make that happen.
And interest rates in the US will go up at some point, and when they do, and they're already rising, and when they do, the relative attractiveness of the Australian dollar becomes less. So I have a reason for doing it, but I can ride a 2-cent move against me, and that's not a problem.
It's
Whereas
relevant.
when you're trading, when you use leverage and you use these, what are those accounts called? The margin foreign exchange accounts.
Absolutely, CFD accounts.
It wipes people out in small moves.
Let's go to you. What do you think investors should be expecting with our scenario is interest rates lower for longer. It won't move up in December. It'll be low for a long time. What do you think they should look at?
I don't purport to have any ability to be able to predict where the stock market's going this week, next month, next year. But what I do know is that there's not a lot of value in the good quality companies at the moment. Despite the sell-off, we're seeing companies that downgrade drop a lot, but the companies that aren't downgrading, their share prices are relatively well supported. They're not below their intrinsic values yet, and I think the opportunity will present itself, and you need to wait until then. So I can't give you a number. I don't know what the number is going to be.
Yeah.
We always aim for 15% a year. That's it's a soft target. We don't think we'll get it every year. To date we have. We've generated almost a 40% return in 2.5 years compared to the small ordinaries, which is down 21% in that time. So we've outperformed it by almost 60%. But I don't believe that'll continue. But that's our aim. We're trying to, if we can get 15% a year, we know we can double our investors' money every 5 years. That's a good aim.
The idea that Magellan, I went to the Stockbrokers Association. I don't know why. I got invited and I was to do the talk, which was great because there's a joyless recovery happening there in the stockbrokers. They aren't making any money, but Magellan seems to be the talk of the town. They're getting lots of money. How's their performance been compared to you?
Well, been excellent. Well, I should say at the outset, Hamish Douglas and Chris Mackay, who run Magellan, are friends of mine, and Magellan Financial Group owns a minority stake in Montgomery Investment Management. They own a little piece of Montgomery. We're the only Australian boutique that they have a stake in. So we refer to it as a strategic alliance, and we think we'll do more together.
And clearly I didn't know that.
I need to disclose that before I answer the question.
Great question I created there.
But obviously they're going very, very well.
Yeah.
And the great thing is the way they manage their portfolios. So their portfolio construction technique is such that Hamish is very, very confident that even if the US stock market were to decline substantially, their portfolios wouldn't decline by as much. And it's all in the portfolio construction and the way they manage that.
We'll talk about that after the break, but before that we're going to leave it here. You will be on Speaker's Corner. So we are going to go to a break, but Roger, you have 30 seconds to tell us your most important issue of the day. Let's go now.
Okay, so I believe that the Australian economy is at risk of a recession. I don't mean a technical recession where we get 2 negative quarters, but I mean it's going to feel a lot like a recession, and this is going to come from the recession that already exists in mining and mining services. That's going to present opportunities in the stock market because as the stock market declines ahead of a recession, prices will fall below intrinsic value, so you need to have cash to take advantage of that. The time isn't right now, but you need to be ready and sharpening your pencil.
Welcome back to the program. I'm Mark Todd from FIIG Securities, and joining me in the studio tonight is Roger Montgomery from the Montgomery Fund and Adam Goldstein, the chair of the New South Wales chapter of SPA and a principal of FIIG's Goldstein. Thanks for joining us on this Friday night. If you have any questions about the share or bond market, please call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. And we have our first caller for the night. It's Mark from Brisbane. Hello Mark, how can we help you?
Yeah, good evening. Just a bit of a broad question. If I'm about the age of 35, and I was just wondering, and I have got some money at the moment, and I'm just wondering if you should split it up between 3 or 4 different equities, so like obviously stocks, bonds, some in obviously term deposit, and maybe some in real estate. I know it's a broad question, but with the stock exchange being a bit volatile still maybe going forward in the next 2 years, you obviously wouldn't want to put it all in there, for instance. And, you know, obviously banks and all them sort of companies. A friend of mine told me about a company called Seymour White, which is a road-based company up in Queensland. Those sort of more secure investments away from mining, is that the direction to head in?
Great questions, Mark, and there's a few of them. I brought a chart in, and I just want to point to this chart, and I think this might help Mark get some sense of it, and then I want to offer the thought. What we've done here is we've created a chart that shows, for the viewers at home, there's a green line, and the green line suggests if my expectations were inflation plus 3% over the long term, that'll be the green line. It's quite stable. If I look at the blue line is if I combined all my assets and I split them up and I had 75% equities and I had 25% bonds, that's the volatility, that's the amount of market movement I would expect from these indices. If I compare it to the opposite, where I do 25% equities and I do 75% bonds, you get a much smoother orange line that doesn't have the same volatility.
Which you should have put at the front.
Which I should have put at the front, but you know, it was very short trying to get the people to help me on a Friday. Essentially the key here is that for long-term investing, if you are concerned about volatility, you need to go 75% fixed income, 25% bonds. Now, in answering Mark's question, who's under 35...
You mean 25% equities?
25% equities, 75% bonds?
Yeah.
Did I say something else?
You said bonds and something else.
Slap myself. 25% equities and 75% bonds. I'll now go against it and say that this is an age-based performance. It's about where you are in the cycle of your investment. So I feel, in answering your question, Mark, you need to, I think, what Roger's talking about is getting more up the curve in terms of investment knowledge. I don't think you should be getting investment advice from a friend that says buy a road-based organisation in Queensland. I think you need to, you know, that's a great friend to have and just converse, but I don't think you should act on it. I think you should work on the education piece and be comfortable in what you're buying at an investment level, but buy a lot of equities, because at your age you need more growth at under 35, and over time start to buy some fixed income. Now, if you were to buy fixed income right now, if I'm Mark, I would buy the Sydney Airport Linkers at 4% plus inflation for the 2030s. I think that would be a great bond to buy, and that's the one bond I'd ask you to buy, but the rest of the time put your money into pretty much equities. Now, tell me I'm wrong.
Yeah, I think you're wrong.
Good.
Obviously, I start this conversation differently,
Yep.
and I'll be looking at time frame and objectives as opposed to what rate of return we're looking for. We're talking about a 35-year-old who has let's assume this is lazy money that's going to be sitting around for a long time. I'd be more inclined to be, 100% growth, just so long as there is.
Isn't that what you mean?
That's what I said.
Equities?
I thought you said 75% bonds.
No. I'm saying buy all equities. I'm saying I'm going completely against what that chart shows. That chart shows me that somebody who doesn't have Mark's age, who is more in his 50s and 60s, he needs to start thinking, okay, I'm not going to lose an awful lot if I go 75 bonds. But for somebody who's 35, put it in growth.
I agree.
Have one thing, which is inflation.
Especially with self-managed super funds now, people are in, they go to pension phase and they're required to take a set amount out. And the problem with equities, when you try and match those two things up, is you're forced to do the reverse of dollar cost averaging.
Absolutely.
You're forced to sell equities every year, even if the share price is low, which means you have to sell a lot more equities to get the required dollar value out.
That's why you've got to go through it.
That's a big problem.
But that's why you're matching with your assets. Yeah. So obviously you would put yourself in a position.
But it's not a concern for our 35-year-old.
No, Mark in Brisbane, but the concern is if you take the advice of Seymour.
The issue I've got, we've owned Seymour White before, and we know the business very well. We've spoken to management several times. that isn't one that's coming up on our radar as something that you should be interested in. Having said that, I would you do one of two things. Either become a know-something investor, which means you're actually going to learn how to identify businesses and value them. And if that's not the case, then you look for a fund manager that knows how to do that.
That you can trust.
Well, yeah, someone that you believe they know what they're doing. I'm not suggesting us at all. It's anyone that you believe they know what they're doing, and they generate good returns over long periods of time. Otherwise, you're going to do it yourself. But it's a lot of work to do it yourself, and then you've got your eye off your family, you've got your eye off your job, you've got your eye off all the other things in your life that are actually important because you're chained to a desk and a computer screen.
Is it that much different in terms of the amount of analysis you need to do on the fund managers? I mean, is it how much more work are we talking about? If I'm looking at some investments at some of the nice reval levels that you're talking about, I do worry about fund managers. They move.
Yeah. Well, the thing is, there's a couple of key ingredients. One is you want stability in the team. So you need the team to be stable over a long period of time. You want them to be incentivised. You want to make sure they own the business. Otherwise, they could go. The guys picking the stocks. And you want to make sure that you're happy with the style of their investing and then their returns.
And if they stay consistent with that style.
Absolutely.
We can talk about that after the break. We will take a short break. If you have any questions, please, on bonds or equities, call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. We'll be back. Welcome back to the Bonds edition of Your Money, Your Call. If you have any questions on bonds or equities, please call us. The lines are open, 1300 30 34 35 and the email yourmoney@skynews.com.au. And we're going to go to an email from Casper. Casper writes, I have recently allocated my fixed income into floating rate bonds. Given cash rates are at historical lows, is this an appropriate allocation? Casper's from Linfield.
That's just around the corner.
Yes, it is. What are your thoughts?
Great idea.
It is?
Great idea. Depending upon where the rates move, you're always going to make sure you maintain a margin above.
Yep.
It's a great counter for inflation, for example. As rates move up with inflation, so the yield on your bond, it's a great idea.
I like the NAB caps. The NAB caps are in the low 3% above the cash rate, and I think they're an old structure, 2016 maturity, or it's a 2016 call date, and they're 300 over the cash rate. I like the look of that for a 3-year duration. It's pretty good. Any thoughts on Casper moving into floating rate from fixed?
Not really.
I didn't think so. That's the shortest answer Roger's given us, and that's quite a challenge for me. Let's have a long one. Talk about Japan. Tell me about the what's your thoughts in terms of the Japanese governor has said, I will communicate more by saying less. And my interpretation is that Monty Python.
Back in December, you got the clearest, as a trading opportunity, we're not traders, but as a trading opportunity, you had the clearest ever trading signal I've ever seen in my life. They came out and they said the Nikkei will be at 15,000 by March.
Yeah.
And it was 11,000 or something like that. And you just thought, and people questioned it. Really? And they didn't tell you what they were going to do. They told you what the outcome would be.
Yeah.
And
just watch. We're going to move this up.
It was very, very obvious. You know, we sat there in the office talking about it. We couldn't do anything about it ourselves, but it was a very obvious opportunity.
And what do you think of the Japan and the Q? I suppose my question, to some extent as well, is will it be successful? Look at it's only just started. Well, at the same time, we'll be talking about.
There's 3
You ain't seen nothing yet, baby.
You ain't seen nothing yet.
Yeah.
You ain't seen nothing yet.
What do you think?
At the end of the day, QE depends on where the money's going to end up. If it ends up buying US Treasuries, at this point in time, probably not a good idea. If it actually ends up in the real economy and stimulating growth and jobs and getting inflation up in Japan, a great idea.
It's all about lowering the currency to make the exports more competitive.
Do you think, to some extent, how relevant is it to the people at home, the Japanese?
I think it's very relevant because the way it works, the way the world works now, is Japan's expansionary balance sheet policy pushes the currency down. Mm-hmm. That causes everyone else's exports to be less competitive. They're forced to cut prices. You end up in this deflationary situation, which is what comes after disinflation. You get disinflation, then you get the risk of deflation. Now, everyone's worried about QE ending, and I don't think that's anytime soon.
Nope.
Because of what's happening, because of the deflation that's occurring as a result of what Japan's doing.
Yeah.
And so how does that affect Australia? Well, it means that for the time being, you wouldn't expect a crash, for example, in the US stock market. So it means that it's, if you don't mind me using the expression, it's risk on, as you know, and I hate using it because you hear all that.
First and only time we're going to have risk on.
We're never going to say it again.
Never again.
But that's what it means. But
Yeah.
for Australia, you've got this potential supporting influence for the stock market, but a negative influence on our currency. So you think about what businesses can I invest in that might benefit from a lower currency, because I believe the Aussie dollar is going to go down, and so that's the issue.
And I think to some extent, if when people ask me why is that relevant, I just say think of Geelong.
Yeah, right.
Car companies are gone. I mean, the manufacturing sector is hurting. Its impact is legitimate. It's real. That's right. It's a real challenge to policymakers when they look at the currency going the way they are, and Korea is saying, hang on, this is not right. And so there's all this dialogue around a G7 conversation that says, Japan, are you really doing what we need you to do? Is it going too far?
We can't have a prosperous nation where we're demanding our businesses forever charge lower prices for their goods and services. At the same time, we expect them to pay $60 to a university student on a public holiday on a Monday to pull a coffee.
Yeah.
You know, it's just not possible. Businesses will not be profitable. They're not competitive, and they go out of business. And that's why manufacturing's dead in Australia.
It's completely. In terms of that, then, what do you think about the US tapering? Because clearly the US have been affected.
It's not going to end anytime soon, Mark. It won't end anytime soon.
I agree. I think there's absolutely no chance. I think it's the effect of Bernanke blinking was an opportunity to trade, because an opportunity to take advantage of the fact that he knows, Bernanke knows that he has to keep the long bond low, because he has to recover in the construction sector. That's where the problems were. He has to keep that going. It creates jobs. My theory.
Here we go.
This is the one I'm working on. My theory is that he has a problem that he hasn't yet articulated. He will taper when employment takes off. There's been no wages growth since 2008. They call it the jobless recovery. So once you start to see jobs recovery, the thing that will follow very soon after is wage pressure. That's inflationary, and that means US companies, where we're buying all these stocks, are not as profitable.
We seem to be a long way from that scenario.
No, I agree.
Yeah.
I'm not saying it's going to happen on Monday, but that's the strategy. Now, that could be a year away from now, but in terms of the investment cycle, when they start to come off, that's when you start to think about it.
Investors are trying to capture the last 100 points.
That's what I'm saying. Don't worry about that. Go buy inflation.
Yeah, I think you need to position yourself for the inevitable end of it. It's not going to happen anytime soon, but it will end. And when it does, the dynamic for investing changes quite markedly. You know, particularly if share prices are very expensive compared to the valuations, which in the US they're not. They're actually cheaper. They're actually cheaper. Despite the big rallies that we've seen in US stocks, they're cheaper. Why is that? Because they've got cheap labour rates, which we don't have in Australia.
That's right, but also they had the benefit. They really had the benefit of the low currency. They had a very low currency. Obama really drove home the manufacturing benefits. He forced a lot of corporations to try and repatriate money, repatriate jobs. So he had that moral suasion, which I think is happening in Japan. I think the moral suasion in Japan is that why would you buy a Japanese bond when you are told to buy at 1%, invest at 1%, and either government will make inflation at 2%. Why would you do that?
Well,
it's because they've got you behind the door and they are saying you are doing this whether you like it or not, because I'm going to move the indices, the equity indices, higher. You are going to take the net benefit, but it's a cultural bit.
Look, the reality is that that's been precisely the dynamic in the United States for a decade. You know, you've been getting negative real rates on bonds for a long time, and yet the bond market rallied.
Safety.
You know, despite that, it's about safety. So you could still make money out of that trade, even though there's negative real rates.
Yeah, and it's the idea that you were saying that everyone wants to go into cash, and people treat the treasury market as cash, so you can see why they've done it. The PIMCO bond performance has been something like 9% consistently over the last 2 years. It's been quite phenomenal. But again, everyone's saying the pressure's on the bond bubble, and I think that bond bubble, we've been telling all the viewers, is basically the government bonds. It's not necessarily the corporates. The corporates aren't having any of that, though in the US it's different.
What you've got to watch out for in Australian corporates is that, you know, in 2013 there's been 127 downgrades.
Yep.
In the listed company space.
So get out of the equity market and buy the senior debt.
Well,
move up the capital structure. Roger, you must agree with that one.
Well, look, I believe that growth comes from owning equity and owning a business, not from lending money to a business.
Why wouldn't you have a combination of both?
Well, I'm not suggesting you don't.
Right,
but my belief is that at any time in your life cycle, you need to have growth in your portfolio. Even if you're retiring today, you need to invest for the next 20 years, and you need growth. Otherwise, inflation's going to wipe you out.
I couldn't agree more. I think you buy inflation. I think I'll talk to you about my Rumsfeld portfolio, but I do believe that I did a presentation a week or so ago, and I wrote, bond salespeople own equities. Equity salespeople don't own bonds, and that was the cultural difference. That they say that we believe everyone should have the growth stocks. But it's time for a short break. We'll be back in just a minute. We'll have some more chat. Welcome back to the show. Joining me in the studio for the final segment is Roger Montgomery from the Montgomery Fund and Adam Goldstein, Chair of the New South Wales chapter of SPA and a Principal of Skeggs Goldstein. We have a caller from the Gold Coast. We have Maggie. Hello Maggie, how are you?
Good evening. Thank you for taking my call.
Pleasure.
I would like to know what you would think about investing $13,000 into an ATM machine for 10 years with a return of 21.69% ex-GST per annum, which is $2,820 per annum paid monthly. It's for 783 transactions at 0.30, that's 30 cents per transaction, and that's guaranteed. It is in a 9 to 5 area, and I'm wondering what you would think about this.
Maggie, can I just ask a question? Who guarantees this?
Specifically, I don't know, but whoever you invest money with, I imagine.
Well, you wonder why they guarantee it, not take the return themselves.
I think, Maggie, part of the issue is with all these things, it's in the fine print, and to some extent, my concern straight away is that the return is.
The outset, Mark, it sounds really attractive.
Yeah, that's my concern.
I imagine all the viewers are on Google now, Googling Gold Coast ATM.
Absolutely, Maggie. So our first up concern is with interest rates being where they are at 2%. If somebody's offering you 21% returns, you need to sit back and say this is too good to be true, because more often than not, it is.
I've got a suggestion as well.
And so in the event that you can understand a little bit more about who provides the guarantee and what consistency around that guarantee might be, I'd hate to think that you are invested in somebody whose guarantee is not underpinned by any financials. In other words, if you look to exercise your guarantee, he turns around or she turns around and says, well sue me, bad luck. I'm a $2 company.
Yeah.
Your thoughts on Maggie's?
Maggie, there is one or two listed Australian companies that were set up to invest in ATMs. Can I suggest that you familiarise yourself with their history and find out why they haven't done as well as they expected to do, and that might give you some understanding of the dynamics in this particular investment sector.
Does that make sense?
Absolutely. I'd put this into the opportunistic category, particularly with the SMSF space at the moment, which I'm assuming Maggie is doing it for that purpose.
I was actually interested until Maggie said it was guaranteed. Once she said it was guaranteed, I thought I'd be very careful.
I'll be very careful on that, Maggie. So please be very careful and feel free to email us with what you learn. Look, we'll take a very quick email. We've only got a couple of minutes left. Can you suggest 3 of the best Australian corporate bonds in terms of yield for a retail investor from Tom? What will you consider right now?
Go for it, Mark.
I'll do it.
It's all yours.
Sydney Airport 30s at 4% plus inflation. Praeco index annuity between 5.75 and 6.
Say it really fast, because then they'll need to call you to find out.
And call me, or you can call Roger, he'll call me, or NAB Caps, which is that 3-year bond. So Praeco, NAB Caps and Sydney Airport inflation-linked bonds.
And they can do that through FIIG Securities?
They can do that through FIIG Securities. You can call Mark Todd and he'll put you onto something. He's very diligent, as Roger will do on Monday when we do term deposits with Roger. Okay, we're going to wrap this up fairly quickly. Any other thoughts? What are the black swans? What's the things that people should be concerned about? We've only got a minute or so.
My biggest concern is the opportunistic attraction of SMSF at the moment. While there's 1 million SMSF members, when this becomes 3 million SMSF investors, I'd be concerned about that.
Roger, what are the black swans? What are you worried about?
I think we need to be very, very careful that the recession that exists in mining and mining services doesn't turn into a broader recession in the economy, because I'm very worried that consumption, household expenditure, net exports won't fill the gap that's left behind, and stock markets tend to fall ahead of a recession.
We need to have some intelligent policy responses for that, so that'll be interesting to see.
Hopefully after September.
Well, yeah, it's been quite scary at the moment. The behaviour of some of these people at the moment is nuts.
Oh, I think they're thinking. I've had breakfast with a few of them, and they're thinking.
Well, I'll go to that breakfast.
Big picture.
I'll go to that breakfast. I'm looking forward to having those chats with your friends. That's all we have time for today. Thank you so much to our guests, Roger Montgomery from the Montgomery Fund, Adam Goldstein, who is the chair of the New South Wales chapter of SPA, and the principal Skeggs Goldstein. And to you all the viewers for your calls and your emails, thank you very much. It's been greatly appreciated. Until next time, I'm Mark Todd from FIIG Securities. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether you're